Hi, this is Sid, and you're listening to The Economic Story. Today is Feb 20th, 2024, Tuesday. In today's episode, we will talk about the market action from CPI and PPI last week. If you followed the markets today, you'd have noticed that the market level indices basically closed down for the day. At a high level, there appears to be a few factors at play in the market. Number one, the market has remained hot for the last few weeks and needed to cool down, or at least consolidate in some way. Number two is the fact that NVDA and the AI stocks had been pushing the market up for the last few weeks, and as the earnings announcement for NVDA approaches, which is pretty much the leader in that specific theme, a level of anxiety is starting to set in. What if the market doesn't like their earnings? So this is basically sell the news happening ahead of time. We don't know exactly what's going to happen actually when the news comes out though. Number three, all of this is happening in the backdrop of these two important inflation readings that came out last week. And these two readings both came out hotter than expected. The first one is CPI, which is Consumer Price Index. And the second one is PPI, Producer Price Index. I will touch upon both of these economic indicators later on in a separate episode, but at a very, very high level, the CPI measures inflation being experienced by the consumer, while the PPI measures inflation being experienced by the producer. In a very generic sense, inflation and deflation tends to flow from the producer to consumer, that is, along the same path as goods and services. In the latest report, there were two primary culprits as to why inflation kind of jumped just a bit on those two. One's rent, the other one is services. Rent is expected, though, to continue to cool down as more and more rental contracts get renewed, and hopefully the negotiations out there result in not as much of price hikes. While on the services side, that's a little bit more tricky. Not really much time to touch upon the complexity around services, which is tied in some ways to wages, strikes, and contract renegotiations. All in all, the equity market has shown some anxiety around the possibility of return of inflation. What is interesting is that the bond market, though, it didn't like the CPI report, but it didn't react much to the PPI numbers. While on the equity side, equities did react way more to the PPIs. It did react to the CPIs initially, but then it recovered everything it lost, almost everything it lost. On my personal end, while I agree that we have to keep an eye on inflation, but the situation doesn't appear to be that scary, at least at the moment. There are two reasons for that. Number one is that in the last few months, we have seen a good number of producers around the globe seeing deflation in their markets. It is not unexpected to see some sort of reprieve, some sort of base effects play out when they have gone through a lot of price cuts, which we have not seen on the consumer side as much. And this I'm talking about on a global scale. Number two, while there has been a jump in month-over-month numbers, the jump appears to be within the range of expected variances. Now, these month-over-month numbers, just so you know, they tend to vary quite a bit from one month to another, so there is a bit of a jumping effect. That's why it's easier to follow the trend when you're looking at year-over-year numbers, which do have other issues that you need to also account for. But month-over-month numbers have this jump effect. And while this jump did happen, it still appears to be keeping all those numbers within the range of variances that you typically see in certain months. Now, looking ahead, the question in front of the market is this. Are we looking at rate cuts, rate on hold, or is the worst case scenario of rate hikes at play? Well, what do you think? Keep an eye on what's happening. Keep an eye on the economic numbers. That's it for today. Thank you.